Well, good evening, everyone, and welcome to this quarter's fourth quarter capital market review. Here we are in sunny Fenton, Michigan. This morning it was 14 below as I was taking the trash out. Now, I know some of you on the call are listening from warmer climates, so great decision to be out of the area, certainly. Well, we've got a lot of interesting information to talk about today. Obviously, the year in review was exceptional, much better than anybody would have thought. I know if you listen to these calls quarterly, I've been saying for quite some time that the valuations are getting ahead of themselves. We're expecting a pullback, so on and so forth. And I feel sort of foolish because we haven't seen one yet of any measurable note. Valuations just the same or even richer today than they were last quarter or the quarter before. So the theme today is looking forward. We'll certainly talk and touch on what transpired last year, but I want to also look at where we are today, specifically from the standpoint of valuations and where the economy is today as well. We're still muddling along. The economy is not about to fall into a recession. But just the same, we're not seeing the typical growth that we normally do this far into the recovery. As always, we do these presentations because we do think the economy matters. It's important to look at growth and jobs, profits, inflation, interest rates, and other major components of the economy. The hope is, as this data starts to turn the other way, as the data starts to look a bit negative, we can then talk about what can be done to perhaps better prepare and protect the portfolios. The idea is to reduce exposure somewhat where we can if we know that it looks as if the economy is starting to weaken and rolling over into a recession. I don't want to confuse things. That's clearly not the case today. The hope is to answer a couple of questions, where we are and, more importantly, where we're heading. And above and beyond everything else, the real hope is to avoid making frantic decisions, to kind of stay balanced, stay diversified, and stay invested. So the agenda today is really wrapped around three themes. And the themes for the quarter are the U.S. market. We want to talk a little bit about where the economy is presently, where the Federal Reserve is presently, and what this means in terms of reducing or potentially reducing quantitative easing. And we'll also talk about valuations, stock market valuations as we see them today, and try to put that in some historical context. We'll also do almost the exact same thing for the international markets. We'll talk about the economy as it looks today. We'll talk about central banks and their effort to lower and continue to lower interest rates. And we'll also talk about valuations, both in terms of developed Europe as well as the emerging markets. And then the last thing, as this is the beginning of the year, we'll talk a little bit about 5 resolutions for investors. Really, it's more or less, here are 5 things that just are good practices to have, whether it's 2014 or 15 or 2012. As a reminder, or maybe to inform those who aren't aware, if you go to our website, KaydanWealthManagement.com, I did record 12 financial resolutions, and it's a slide presentation that talks about a number of not only investment resolutions, but just general wealth theme resolutions. Feel free to take a look at that, and let me know what you think. So as we do every quarter, before we get into the nuts and bolts of the theme and the agenda, we try to spend a few minutes just to kind of ascertain where we are. This chart that we've been using every quarter for the last several years keeps looking better and better and better. If we look at this, and by the way, I'm kind of using a little bit different software, so we'll see if I get this right. If we kind of look at this period here, this is the big recovery leading up to the financial crisis. The markets were up about 110 or 101%. We saw about a 57% drop. That's the same here as in Europe. We'll see that in a few moments. And now we're about 173% above where we were at the very bottom, March 9th, 2009. That recovery certainly exceeds the recovery here and also the recovery leading up to the dot-com bubble. Doesn't mean things are ridiculously expensive yet. If you look at the PEs, or the price-earnings ratio here at the peak October of 2007, about 15.2 times earnings. And now, in terms of forward earnings, about 15.4. Clearly not 25.6 as it was over here during the height of the dot-com bubble burst. The interesting thing about this one, though, is valuations were ridiculously crazy. People were assigning valuations to websites based on the stickiness of eyeballs of viewers and had really nothing to do with earnings. So I wouldn't really use this as a proxy. It would be just in bad judgment to say, well, we still have a long way to go to get back to this level. We certainly do, but the likelihood is we won't see that. Also, valuations plunged to a very low point, about 10 times earnings at the very low point in 2009. So we're at a point now where I would have to say, look, there are no bargains. Things are certainly fully priced. Doesn't mean they can't get pricier still. And a lot is really going to depend on what happens to the economy this year. Do we get the surge in economic growth? Does the consumer participate? Do we see an improvement in CapEx spending? All of those things can ultimately improve earnings, which will drive down PE that can then make this look less fully priced. Let's also look at interest rates. This chart, which we've looked at a number of times before, shows the last 30-plus years of a falling interest rate environment, and that's certainly been a huge catalyst to stock market performance over that 30-plus year period. We've also noticed here at the very bottom a slight uptick in interest rates. I suggest that's probably the beginning of a much, much longer term trend. If you go back to the peak of 2000, or actually 1981, and you look at the fact that interest rates had been rising for a period of time, this particular graph stops about 1950. You could actually go back to about 1945, and you would have noticed we had 30-some years of rising interest rates, followed by 30-some years of falling interest rates. I'm not suggesting that interest rates are going to rise for 30 years, but we're probably going to see a protracted period of time where interest rates become more normalized. If you look at average yields over an extended period of time, we're a long way from that, as normal average yields are about 6% for 10-year treasuries versus 3 at the end of the year, and now about 2.7 or so as we speak today. This has an impact. That rise in interest rates that we saw here impact pension payouts. You find that if you're working and have a cash balance pension, the payout amount now is less than it would have been a year or so ago, and probably will be less a year or so from now. As far as money in motion and what this meant, especially from the standpoint that interest rates caused bonds to be a bit weak this year and the stock market was inexplicably strong, we saw a couple of things happen that we haven't seen happen in a while. This particular chart, the mutual fund flow chart, shows money movement between various types of investments, stock mutual funds versus bond mutual funds. It also includes ETFs as well. And a couple things that we'll notice. One is just very late in the year last year, we saw for the first time the fact that there was positive flow, that is more money going in to equities than money going into bonds. And that's a recent phenomenon. If you consider the fact that over the last 5 or 6 years, there's been just an absolute incredible amount of money flowing into bonds and an incredible amount of money flowing out of stocks. In fact, if we look at that, if we kind of look at this a little bit closer, we'll notice that over the last 5 or 6 years, since the market bottomed 2009, we've had just every year money coming out of stocks and a huge amount of money flowing in the bonds. Just recently has that effectively changed. So the idea is, if this is a trend, and as interest rates rise and create problems for bonds, we could see more of this flow. So it's not as if the market has lost its fuel for growth. With that said, let's move on and kind of talk about the agenda. U.S. markets is the first area we want to talk about. And with respect to U.S. markets and U.S. stock markets, they're generally fueled by three things. One, economic activity. Is that accretive and additive to stock market valuations, or is it a negative to those same valuations? The other thing we look at is liquidity. Is there a lot of fuel still in the system? And the third thing, and probably most important, is valuation. So we'll start with the economy. And when we look at the economy and we look at the economic composite, a couple things you'll notice. First is the economy is still kind of limping along. Actually, year-over-year GDP growth has been tracking at about 2%. It was actually less than that until recently, compared to about 3% on average for a 50-year average. So we still have a long way to go to get back to trend line. That is beginning to improve, however, and for the most recent quarter reported, when these slides were produced on December 31st, was actually the third quarter. You notice that we had about 4% GDP growth. So GDP growth improved a bit for the quarter, and that certainly helped. Looking at the composite of GDP, all the things here that kind of make up GDP, every one of those should be accretive and improving this year and should help improve the prospects of GDP growth. We'll talk in a moment about the Federal Reserve taking back some of this federal stimulus. The thought is, or the consensus, I should say, among a lot of economists, is we're going to see better GDP growth this year, and the extra GDP growth this year should help offset some of the retracement or reversal of Federal Reserve stimulus. So that will certainly help offset that potential negative. Let's talk about consumer finances. Here, things look great. Consumer balance sheets are very strong. If you look at total household assets to total household liabilities, it's very, very strong. When you talk about household net worth, this number right here, we've seen a $14 trillion improvement in household net worth just the last 2 years. About $8 trillion this year alone, this past year, and on top of $6 trillion the year before. As a result, that really helps to stoke consumer confidence. When home values are higher and you refinance to lower debt and 401k balances look better and your investment accounts look better, it tends to cause you to feel better about your prospects in some cases. Some people actually feel more comfortable. I'm not suggesting this is right, but feel more comfortable taking on a bit more debt. They feel more comfortable maybe taking on a bit more risk, which is usually kind of late stage stuff, but that happens as well. Look at this as well. Look at household debt service levels. This is a significant drop over the last 4 or 5 years. It's as low as it's ever been recorded, and that's the amount of debt payment as a percentage of disposable personal income. Extremely low, very affordable. Unemployment has been improving. That's been a disappointment. The unemployment rate today is still significantly above the long-term trend, and it is surprisingly still very high compared to where we are in terms of the economic cycle and where we are in terms of how far into this recovery we are at this juncture. Unemployment, as you'll see here, is a late-stage event, and we're really not going to see a lot of CapEx spending, corporations adding equipment and whatnot, until the number of jobs gained equals or surpasses the number of jobs lost. And we're still about 700,000 off of that mark. And the reason is pretty easy to understand. If a corporation has full employment and has added equipment to the mix and then laid off a number of people, as we saw here,
that corporation still has those plants, in many cases, still has all that equipment. And until they replace the jobs lost with jobs found, and everybody's sitting in front of a production piece of equipment, the company is less likely to go out and buy more equipment. If this year we get to the point, second half of the year, where year to date we've replaced the 700,000+ lost, we might actually see a kick in CapEx spending, and that would help kind of stoke economic growth second half of the year. Fed finances, if you look actually, the amount of spending versus the amount of borrowing, actually the amount of borrowing has actually come down a little bit. A part of that is because of sequestration, some horse trading that was done. In fact, if you look at net debt to GDP, it's actually dropping here a little bit, and you can see also federal budget deficits have dropped here a little bit, and then they start to ramp up over time. What this effectively means is that this year we'll have a little bit less headwind on the part of U.S. government roadblocking. The sequestration, the big tax increase that we saw at the beginning of 2013, all of those things were kind of front-end loaded, and they had a severe and impactful effect on our GDP growth in 2013. In 2014, it is less of an impact. Rates aren't going up sequentially more than they did last year. Sequestration shouldn't impact us more than it did last year. So as a result, the big hit that we got up front tails off a bit this year and the following year. As we're talking about the economy, one big plus and improvement is housing. And if you look at housing and look at all the people that are associated with housing, it's a significant catalyst to economic growth. Clearly, we've seen a huge improvement in home pricing, not only the Case-Shiller Index, but the FHFA and average existing homes all across the board. And in your own neighborhoods, you may have noticed home prices have stabilized and improved. When you look at the inventory, you're seeing a few more homes available for sale. And one of the reasons for that, as pricing improved here, you had more folks putting homes for sale. That's probably a short-term blip. If you look at home affordability, it's, again, nearly as low as it's ever been. The slight uptick here that you've seen at the very end of this chart represents the slight increase in mortgage rates as a result of the rate increase that we saw this past year. A couple of interesting things with respect to this chart. One is if you look at the number of new households created every year and the number of new home structures created every year, the thought is we're between 400 and 500,000 units shy every single year. What it would take to get above trend is a significant move in either house demand or manufacturing. And we really don't see that happening anytime real soon, which means pricing could continue to come up a bit. If you go back to this chart about affordability, to get from where we are here to trend line, which is average, and by affordability this is the average mortgage payment as a percentage of household income, you would have to see either a dramatic increase in interest rates off of where they are today or a significant increase in home price, like a 50% increase. And we're not going to see either of those. So the idea is home pricing will probably stay affordable for several more years to come, and that should really help stoke the economy and the commensurate economic activity. This chart is really could be used for Europe when we talk about the rest of the world, what's happening there. But I wanted to share this with you today just from the standpoint of export possibility. This is really, really positive. This is a manufacturing momentum chart. It's also called a heat index, and it's showing over on this side all the various countries. It shows the various months going back to January 2012 right up through December. If you see red, those numbers are typically below 50. Below 50 indicates a recession or a reduction in economic activity, and a number above 50 indicates growth. The greener it is, the greater the number is above 50. U.S. has been above 50 for the last several years. We've been out of a recession. The bulk of Europe has been in this quagmire, in this recession, for quite some time. The whole euro area, Germany, France, Italy, they all have. Now, if we look at where we are today, you'll see most everything is green. Europe, to a large degree, is net positive. The exception is France. We hear about that in the news here recently, and certainly Greece, although Greece has improved from 41 to 49.6. So the U.S. has been out of a recession for several years, and Europe is just now coming out of a recession. That will be very positive for U.S. Exports as we move ahead. We can't leave the discussion of the economy without talking a bit about inflation. And there really has been very little inflation. And one of the reasons is there's been very little economic activity and very little momentum in terms of U.S. dollar velocity. But that being said, we're way below trend line. The average trend for inflation is about 4.2%. That's the 50-year average. Headline inflation, we're at about 1.2. And core inflation, surprisingly, is 1.7. Core is the inflation rate that typically is used for Social Security increases. It's also used for many corporate raises, or they use that scale and adjust it. So why is it that core is actually higher than headline? Because typically it isn't. Well, once again, as we've talked about this once before, but we can kind of review it again here a little bit. If we look at the components that make up the headline number, let me just see if I can enlarge this. Perfect. If we look at the components that make up the headline number, things such as food and housing and apparel. Housing represents 41%. For the longest time, that kept this index down because home prices fell through the floor, and as a result, the comparative of buying versus renting was super cheap, and as a result, the headline number was down quite a bit. You'll see it's actually 2%. It's increased a bit. But the CPI number that everybody talks about is the core number, not the headline, and we reduce things like energy and food, which is kind of nonsensical, as if that doesn't exist. And for most of us, those are two of the larger components that we spend money on, especially retirees. Well, this past quarter, energy, petrol, fuel, gasoline, whatnot, actually dropped 2.5%. So by taking that component out, it left the core number slightly higher than the headline number when you effectively weight it. So that was a bit interesting. We're not going to see a lot of increase in inflation anytime real soon before we really start to see what will be worrisome inflation, and I'm sure we'll see it here at some point, probably not in the too distant future, but just not immediately, is only after we've had full employment, we see the CapEx spending cycle kind of pick back up, and at the same time, an increase in the velocity of money changing hands in the economy, which it just flat out isn't doing right now. This becomes a great transition to what is happening with respect to the Federal Reserve. With respect to the Fed, they continue to add to their balance sheet. We can see that here. The balance sheet continues to increase. Most of that is as a result of the Federal Reserve going out every month and buying bonds, mortgages, and federal notes. And as a result, that money is just staying on the books. These are Fed assets. These are Fed liabilities. They're almost identical because the Fed doesn't have anything other than cash to deal with. And the bulk of these assets are now excess reserves, which are a liability for the Federal Reserve. So the bank gets the money, the bank leaves it at the Federal Reserve, they receive a interest rate, and they pay us hardly anything on passbook savings. So without taking any risk, they're earning a very, very slight spread. As a result, the money multiplier, the number of times a dollar bill changes hands in the economy, is about as low as it's been in recent recorded history. Historically, in a healthy economy, the multiplier is about 8 times. So a dollar bill will change hands about 8 times during the course of a year. It's been about 3 times. That number will pick up at some point, and it probably will pick up when the Federal Reserve does decide to raise rates. They're not going to raise rates anytime soon. What they'll do this year is they'll reduce the stimulus. So this number will continue to rise, but probably at a very, very slow rate. This number clearly isn't going to roll over. They're not reducing the assets. They're not selling assets. They're just going to stop buying. Once they stop buying, then and only then would we ever see a potential increase, and that'll have everything to do with where we are in terms of economic growth. But once interest rates rise, then the banks will earn a greater spread by borrowing the money and taking the risk, in which case some of these excess assets will leave the Federal Reserve and will start changing hands in the economy, and at that point you start to see classic inflation. Too many dollars chasing too few goods. We won't see it anytime real soon. I'm more worried because of this. I'm probably more worried about an asset pricing bubble than I am inflation at this point, as we're still throwing an awful lot of fuel on a fairly richly valued market. Great transition to valuations. So there are a couple ways to look at stock market valuations. We can look at it from the standpoint of the multiplier, of the PE, and you can see we are above average at 15.4 times forward earnings. That's quite a bit above the 14.9 average. So we're not in super thin air, but the valuations certainly aren't what would be called cheap. Corporate earnings continue to grow. They're growing at a slower pace now than they did coming out of the recession, which is also fairly typical, and we would expect those earnings to continue to grow for some time. Another way of looking at valuation beyond price earnings is to look at it on a relative basis, and that's relative to Treasury yields. So a comparison here of the inverse of corporate earnings, or an earnings yield, to an investment-grade bond yield. And right now, the earnings yield on the S&P is actually above the earnings yield on a bond. Anytime the earnings yield on equities is above the yield on bonds, the equity market is deemed to be cheap or cheaper. Historically, the earnings yield on the S&P is about 0.9 or 90% of what it is with bonds, and presently we're at about 120% above that. And you'll see that as the stock market values have increased, that inverse yield has come down and bond interest rates are coming up. So we're getting to the point where we're getting to a pinch point here. Anytime the green line is above the blue, relatively cheap value. Anytime the green is below the blue, things start to get a bit pricey. So you could argue that there's still some room left in terms of price appreciation. Again, all this could change if we have better economic activity. And this is just related to the U.S. market, not Europe or smaller cap or technology, but just broad-based U.S. equity market. Let's talk about bonds. If there was one area, one chapter in the economic book this past year that was not terrifically exciting and perhaps a little bit painful, it's what happened with bonds. Interest rates really didn't move at all. The Federal Reserve didn't raise rates one iota. But most bonds are traded at an auction market where you have buyers and sellers, and they meet in the middle and agree on a price. And in May, Bernanke gave a speech and indicated that at some point the Federal Reserve was going to pull back on the stimulus, the quantitative easing. Everybody knew about it, everybody expected it, but to hear it out of his mouth shocked a lot of people. So bond buyers immediately demanded to be able to buy bonds at a lower price, to price in a higher yield. And that happened quickly, and the 10-year Treasury, which at the time was trading at 1.65%, immediately started to move north. And in a little over 5-6 months, we went from something below 2 to something above 3. Huge move over a very small base. So this is kind of an interesting chart because it kind of shows what happened last year in terms of return in the bond market. And it actually shows the components that make up the total return in a bond. We know that bonds work inversely to interest rates, kind of like a teeter-totter. If you push down on interest rates, the other end goes up. That's good. And if you push up on interest rates, which is happening now, the other end goes down, meaning bond price goes down. So if we look at the first chart, this one here, and you go right down the line, doesn't matter what kind of bond we're talking about. Are we talking about treasuries, 5, 10, 30-year, municipals, high-yield bonds, emerging market debt in U.S. denomination? Are we talking about mortgage-backed securities, the U.S. Aggregate Bond Index? That used to be called the Lehman Brothers Index. It's now the Barclays Index, or triple B, which is the lowest grade, investment grade, before things become high yield or junk. Every single one of those had a negative price return last year. Some were significantly greater price drop than others. Generally, as you had bonds that were more stock-like, they had a lower sensitivity to interest rates. The longer the maturity, a 30-year treasury, the highest the quality, the greater the sensitivity. So 30-year bonds were down nearly 20%. When you look at total price, however, it's a component of several things. One, the relative movement in the base return rate times the spread to Treasury returns. That's another way of saying that is the sensitivity to Federal Treasury returns. And then the coupon return, because these bonds also throw off some interest. So the bond's going to throw off interest regardless of whether the price is going up, down, or sideways. So you add that back. So you add all this back, and what you get is total return, which is the A column plus the B column plus the C column. So you'll see treasuries were down about 15% for U.S. 30-year. High-yield bonds were actually up for the year. The aggregate was down about 2. In general, bonds were down across the board. If you had a well-diversified bond portfolio, you were down a bit last year. Now, what does this mean for this coming year? The expectation is interest rates are probably going to go up again, especially as economic activity improves. But when interest rates go up, the duration or sensitivity to rising interest rates comes down a bit. So another way of looking at that is when these bonds were priced at 1.65, to see them move 1.3% was huge. If we saw the same increase in bond rates today, another 1+%, But now, off of a base of 3, it's less sensitive. So the best we can hope for, I think, with bonds this year will be flat to slightly negative. It won't be quite as negative as it was last year because rates have come up a bit. But we are not going to expect bonds to generally provide any positive return to the portfolio. And that's important to remember because we have bonds in the portfolio to reduce stock market risk. And what we don't want to do, especially with valuations as high as they are, is to fall into the trap of now getting rid of bonds to chase stocks, because at that point we now are way overexposed to a very rich stock market, and that's just asking for trouble down the road. All right, let's move from the U.S. to the rest of the world. And when we look at the rest of the world, we'll see in general the rest of the world, Europe, Europe X, the UK, Pacific region, emerging markets, total return in local currency were all much, much less than the U.S. market. In U.S. denominated currency, in many cases, they were even weaker still. So the U.S. market got really strong really fast. The fourth quarter's performance was ridiculously strong, and we saw a huge, from the chart before, a huge amount of money coming into the market late in the year after May that kind of goosed up the returns as well. But if we look at the market from a valuation point of view, and by looking at these components, what we're really looking at is dividends, the price earnings multiple, and then corporate earnings. So what we're going to notice here is U.S. versus Europe, first column versus, or first row versus second row. Dividends are generally greater in that second row, the brown box, compared to the U.S. So in Europe today, I can buy companies that are giving me a higher dividend yield and are generally trading in this kind of steel blue color at a lower PE than in the U.S. market. So there seems to be a bit better value today in Europe versus the U.S. market. If we look at where the international markets have been and where they are today, this is kind of interesting. This chart is very similar to the one I show every single quarter. It's what's happened with respect to the EFI, or the international benchmark. This move here is a big move after the dot-com carnage, down 56%, up 141%, down 57%, and today we're only up 85%. When you're down 57, you need to be up well in excess of 110+%, more like 120, to get back to your previous high. So today we're still significantly below the previous high. Compare that to that U.S. chart I show you. Today we're at 173% of the previous low, and today we're significantly above the previous high. Interestingly enough, when we recovered here, we recovered 110% compared to Europe's 141. We dropped by the very same amount, 57%, and now we're fairly extended at 173 compared, again, to 85. So there seems to be a bit more value. And for those of you who have seen some activity on your account, you may have seen a purchase of a European fund. We made that last quarter of last year for that very same reason. We think we're beginning to see some improvement in Euroland, and there seems to be a bit better value there. Let's look at what's happening with respect to the banking community in Europe. They're getting their act together. And what I mean by that is they are doing exactly the same thing that the U.S. Central Bank did coming out of our recession a couple of years ago. Bernanke did quantitative easing only after they kept interest rates low and continued to push interest rates lower. Just recently, this week, I think Bank of England lowered their rates once again. We saw, I think, another bank, Germany, one of the German banks lowered rates as well. Here, across the Eurozone, interest rates have come down appreciably. What this is doing is allowing the economy to start to take hold. It's creating some of that same excess stimulus or additional fuel that we saw here. We're beginning to see there. So this is one of the big reasons right here that we're beginning to see in terms of the heat chart, a lot of the European nations beginning to show positive signs of improvement. The European unemployment rate is still abysmal. This will kind of show that Europe is at 12% unemployment currently compared to our 7.3. That's certainly high, and it's been tracking a bit higher still. There's always a lag of the unemployment rate peaking when economic activity is improving. One big positive, though, is their inflation rate is extremely low, actually lower than our inflation rate here. And from a fiscal drag point of view, because they get it and they've been lowering rates and they've been accommodative as opposed to restrictive as they were initially during the fiscal crisis, you're seeing the expectation in terms of government fiscal drag dropping in every single country. So the purple bar represents the expected amount of fiscal drag this forward-looking period of time compared to the gray bar, which represents the period of 2010 through 2013. And in every case, I believe with the exception of Italy, we're expecting less drag, or another way of saying that is a bit more positive stimulus, positive environment. Valuations in Europe as well as emerging markets seem to be a bit better. If you look at emerging markets in general, both in terms of growth rate previously and growth rate going forward compared to developed markets, you'll see that the growth is generally, expected growth is generally greater in Europe, so that could be a compelling reason to invest. We think from a timing perspective, a lot of the emerging markets will go as China goes, and China still has a little bit of work to do, so developed Europe might be a little bit better than emerging market, but just the same over a longer period of time, very compelling. If you look at global valuations with respect to emerging market, to a large degree, they're pretty cheap. The dot represents where they are today. The brown line represents the average valuation, and the blue steel bar represents the range of valuations. So Russia's fallen through the floor. China is really cheap. The emerging market index is relatively cheaper than long-term average. As you get into Taiwan, Korea, South Africa, those countries, those markets are probably a little bit expensive relative to history, but in general, the EU is still cheaper than average, as opposed to the world index, which is a bit more expensive than average. All right, with that, let's move to the last theme, which is 5 resolutions. The first one is don't forget to rebalance. Rebalancing is very important. We do it regularly. We kind of look at portfolios twice a year, purposely to look at whether anything is out of whack from a rebalancing perspective, but we also rebalance a few other ways, as we'll share with you in a moment. The big reason for that is, as you can see from this asset class return chart, there's nothing that's a consistent winner all the time. If you let something ride for a long period of time, you'll have way too much exposure, and you'll find that a winner one year becomes the loser the next, or a winner here becomes a loser, and so on and so forth. So we just believe in rebalancing, make sure we're globally diversified, make sure that we have multiple assets in the portfolio, and generally an average blend is certainly better. In our balanced, moderate portfolio, have we been 100% invested at the beginning of the year? we would have been up about 14.7, and that's with all kinds of things that flat out didn't work last year that could very easily work a whole lot better this year if the U.S. market's returns kind of slow down a bit. If we're dollar cost averaging into the account over the course of the year, getting out of other assets or bonds, then the returns would certainly be less than that or half of that. But those accounts that would have been invested for the full year would have enjoyed a reasonable return with a whole lot less risk and volatility. The reason for rebalancing is simple. If you let a strong position go unchecked, it becomes a very large position in the portfolio, and when things turn, you have significantly more risk. It's generally hard to rebalance because it's counterintuitive. It requires us to sell the winners and buy the losers, and it's usually not what people want to do. We want to kind of pile into the things that work and run away from the things that don't work. We rebalance a couple of ways. When clients add new money, we tend to rebalance, and for those taking regular distributions from portfolio, we're constantly rebalancing by selecting where it is we're pulling assets from. When we talk about looking at the account purposely twice a year, that's because there is some degree of seasonality. It seems like the sell-in May and go away, which represents the worst period for the market historically, May through October. By the way, didn't work at all last year. May through October worked out great for the market, but usually it tends to be a bit more problematic. And as you move into October, November through the early first quarter or so, markets usually do very, very well. So we kind of look at, do we take risk on, take risk off during that period. So rebalancing is important. Another recommendation would be look for income, not yield. With interest rates as low as they are today, and if we look at this chart down here and look at every single country, and if you look at generally where that blue line is, that's real interest rate policy. It's below zero. So when interest rates are literally flat to zero, it's hard to find yield. And if we're chasing yield and looking at items and investments that have an exceptionally high yield, we're usually taking on an awful lot of risk, realized or not. In a global, diversified portfolio, it might be better to look for income than yield. Those taking distributions from IRAs, it makes absolutely no difference whether what we're distributing is coming from interest earned, dividend earned, capital appreciation harvested, or whatnot. It's all taxed the same. It all works the same. So creating a portfolio that can provide income is completely different. It might be a little bit safer than creating a portfolio that's striving to achieve high interest yield. Think global. The biggest reason for thinking global is you're capturing the bulk of economic growth and the bulk of global capitalization. I just want to share with you these two pie charts. Let's talk about the first one first. This represents market capitalization. So if you're developing a portfolio and you're investing in things based on price, valuation, and worth, the U.S. represents just a hair under half of total stock market valuation. Investing in just the U.S. means that we're effectively eliminating 50% of market capitalization. If we look at global GDP, and we're talking about purchase power parity, so that's taking into consideration currency fluctuation and whatnot, emerging markets represent just a hair over 50% of global GDP purchasing power. The U.S., about 19%. So again, having a predominantly U.S. dominated portfolio, you're missing an awful lot of longer-term growth prospects. So think global. Avoid being emotional. Much easier said than done. Human beings were all hardwired, kind of the same way. We gravitate toward things of pleasure We will run away from things that cause pain. As the market increases, we get optimistic, excitement, thrill, euphoria. Clients who remind me often how conservative they are now remind me that they're willing to take more risk and can accept more fluctuation until things roll down the other way. So let's look at this and consider how this kind of plays out. This is the U of M Consumer Sentiment Index, and what it's looking at is where the consumer sentiment is as it's graphed based on long-term average, and you can see we're very, very close to the average and moved up quite a bit over the last several years here. And then the numbers that you'll see reference what the 1 year-over-year return would have been with respect to the market based on where the sentiment is. So as an example, down here where sentiment was very low and people were scared to death of the market, the next year the market did 22%. Here, when the people were scared again of the market, that was 2011, that's when we lost our credit rating, the market year-over-year, after a big drop in stock market value, increased over 15%. When sentiment starts to improve, as it did here in January of 2007, the returns were actually a negative 4% year-over-year, and here a positive 4% year-over-year, or a minus 2% year-over-year. So as people get excited and confidence improves, generally returns drop a bit. I've got another slide at the end that will further show that. Cash is not a permanent solution. Clearly, we have cash in a lot of accounts, probably a bit more cash than we normally would have. One of the reasons for that is cash is not a bond, and bonds have a bit more risk, so I'm running a little bit more cash than I normally would. It is not a solution. I would love to have cash to work, and if we had a pullback in the market, I would be all over the cash position by investing some of that back into the market. I'm a little bit hesitant to do that with valuations where they are. By the way, I don't know if you've noticed, but both the Dow and the S&P are slightly negative since the beginning of the year. It's gone nowhere. So I'm not suggesting we're going to see a big pullback anytime soon, but if I had that in the market today, I'd feel funny about buying at these valuations. If I had that in bonds, I'd be worried about potential loss through rising interest rates. So it's better to have a little bit of it in cash, but it is not an investment solution. By the way, the U.S. economy is swimming with cash. We have a little over $10 trillion of cash sitting on the sidelines, and at some point that may very well be committed somewhere. With that in mind, let's talk a little bit about a couple of takeaways, things that we've learned here. One is with respect to the economy. I think the economy will be reasonably strong this year. The expectation is things improve second half of the year. That being said, I think we'll see more volatility this year than we did last year. Last year we literally saw no volatility, and for somebody like me that was hoping for pullbacks to take advantage of depressed pricing, we really didn't see much opportunity to buy in. This chart talks about price and price matters. This gold line that you see here is essentially the growth of corporate earnings as a representation of valuation, and generally corporate earnings grow at about 6.4% a year. That's the earnings trend. The blue line that you see up and down below the line is generally stock market pricing. And you'll see over this long period of time, going back to 1926, we're constantly critical pathing. We're ahead, we're below. We regress toward the mean. We effectively move in the direction toward this gold line. And right now, we're pretty well on that line. In fact, that was through the beginning of 2012. If we looked at it, and I'm trying to get an updated slide, it's actually a bit above the updated bar. Why that's important? Price matters. And if you look at forward-looking PEs, the Shiller CAPE index, which is actually a PE index. It's an average index, a 10-year average index of earnings. And you relay that to the subsequent 10-year returns at every single valuation point. And he goes back to, well, 120 years of data. So what we're looking at here along this axis is 10-year average annual returns. And along this average, or axis, is average PE. So let's go back when the PEs were 10, back in 2009 after the big pullback. What it basically says here is if you're fishing around and the average market PE is 10, every time that it's ever happened in history, the 10-year returns were clustered in this range, and they averaged 15+% a year, average annual. As valuations have come up and PEs have come up, and we're now at the CAPE PE, that's 10-year average PE, which is different than a 1-year forward average PE of something closer to 25, all of a sudden those returns are more like 7 or 8% a year. Now there can be odd outliers, but essentially the more richly valued stocks are, the less opportunity there is for forward-looking numbers. One thing you'll also notice is the correlation coefficient, the R-squared, which is kind of shows how tightly the actual incidence here, each one of these 10 years, how tight it is against this best fit average. By the way, that slide was created by work done by Dr. Gary Schiller, just won Nobel Prize for Economics this past year. This slide was done by Daniel Kahneman, who also won a Nobel Prize for Economics. And this is the pleasure-pain chart, or the investor loss aversion behavior chart. And basically what it says is, if we're looking over here, this is gain versus loss, and this is pleasure versus pain. So this isn't calibrated, but for every 1 unit of gain, we realize so much pleasure. For the very same unit of loss, we realize significantly more pain. Another way of looking at that is we have an aversion to loss. We feel much greater pain, we feel much worse on a loss than we do on a unit of gain. And generally, we manage money that way. We try to manage money that way. We would rather spend the time trying to protect the downside a bit more than chase the returns. Risk management matters. 100% loss requires a 50% loss requires 100% gain just to get back to where you are. And one of the last slides I want to share is a slide I usually share, and this is needed to be updated. It was through September, and the S&P was only up about 18%. And in the last quarter of the year, the S&P gained significantly. In fact, it was kind of funny because I received emails from a number of clients in and around October. Should we take money off the table? Should we go to cash? Clearly, markets go up when we're the most worried and most scared. The point of this is, regardless of how well the markets do any given year, those are these bars here, plus years as well as minus years, along the way from January to December, we generally get some type of a pullback. These are all these purple little dots. And the average annual pullback is about 14.7%. We haven't had a 10% pullback for better than 2 years now. And those are quite commonplace, as you can see from the slide. So I would expect greater volatility. I wouldn't be surprised if we had a little bit of a pullback, maybe something in that range, but that doesn't necessarily mean that it derails growth for the year. It could create a great opportunity to add to equities if we had such a pullback. So the best advice is stay balanced, stay diversified, and stay invested. I'd like to open up to any questions if you have them. I'd also like to remind each and every one of you that we do have a second opinion service. If you know anyone, friend, family, we'd like to send our way, we'd be more than glad to kind of take a look at what they're doing, how they're doing it, run some analytics on their portfolio, take a look at their best laid plans against their goals and objectives, And it's a valuable tool whether or not they decide to work with us. Obviously, we'd hope they take a very close look at everything that we are about. With that, I want to make sure that we look at not only the disclosures, but all the definitions of risk and all the other investment disclosures that I'm required to make sure you have plenty of time to read. This slide will talk about Barclays Aggregate. We talked a little bit about that. Municipal Bond Index. I think I mentioned the word municipal once. We'll also talk about mortgage-backed securities. I know I mentioned that once as well. And the Barclays U.S. Aggregate, as you might remember, I mentioned that used to be called the Lehman Aggregate. And we talked a little bit about international securities. I don't think I used the term commodity. I just did. And I haven't mentioned mid-cap capitalization, but I just did as well. So with that, I will send it to a thank you slide, and I want to make sure you have all of our contact information as well. If you need anything, give us a call. We'll be on this call again next quarter, and also look at our website, kaydanwealthmanagement.com, as I do have financial resolutions on there. Once again, thanks so much for your trust. If there's anything we can do for you with respect to what we're already doing or other items, please don't hesitate to call.